4,155 Bitcoin are gone from BlackRock's Bitcoin fund. Nobody stole them. No investor sold them. The fund sold them itself, on purpose, to pay its own fee. And that number is not a rumor from a message board. It is printed in the paperwork BlackRock files with the government, the prospectus they hand you, and the accounts they file every 3 months. Here's what that means at your kitchen table. Say you have $100,000 in that fund this morning. At today's price, that is about 1.28 Bitcoin. You are not going to trade it. You are not going to touch it. You are going to do nothing at all, which is the whole reason you bought the thing. And 5 years from now, having done nothing, you will own less Bitcoin than you own today. Not less money, less Bitcoin. About 16 thousandths of a coin, sold off a little at a time, every single day while you slept. At this morning's price, that is roughly $1,200. But the dollars are not the point. The coins are. That is not a scandal. It is the product working exactly as designed. Almost nobody who owns it knows it happens. Let me show you how I got there, because it started with a headline that looked like good news. Last week, $1.92 billion poured into America's Bitcoin funds. Week of the 17th through the 21st. That is the biggest week those funds have had since the week of October 6th through the 10th, 2025. Now sit with that week for a second. The Monday of it, October 6th, is the day Bitcoin printed the highest price it has ever printed, $126,198 on the Coinbase print. So the last time money ran into these funds like this, it was not running in near the high. It was running in during the same 5 days that contained it. That is not a prediction. I do not know where the price goes next, and neither does anybody selling you a target. That is a record. It already happened, and I want you to be able to see this coming without me. That is the whole reason I built the macro command center. The live numbers, on one screen, the same ones I am reading to you now. Now here's the part that should stop you. Back in July, I made a video about the worst month in the history of these funds. $4.5 billion walked out the door in June. A record. The most money that has ever left these funds combined in a single month. Go look at what Bitcoin did in June. On the 25th, it bottomed. $58,035 on the Coinbase print. The lowest it had been since September of 2024. So the money left during the month that bottomed at 58,000. And last week it came back at 78. Same funds, same wrapper. Sold the bottom, bought the bounce. I want to be fair here, because these are not all the same people. Some sold, some bought, some sat still. But look at the shape of the money in total. In total, it ran out at the low and ran back in $20,000 higher. The wrapper did not cause that, but the wrapper made it easy. A share sells in one click. From a phone. At 9:30 in the morning. Next to your other stocks. That is the feature they advertise. That is also the door people walked out of at the worst possible moment. And there is a headline riding along with all this that I want to take apart before we go further, because you are going to hear it all week. The headline is that these crypto funds gained about $23 billion in a single week. Enormous jump. Institutions are piling in, the story goes. Now do the arithmetic they skip. Of that 23 billion, roughly 20.5 billion is not new money at all. It is the same coins priced higher because Bitcoin went up 23% that week, which leaves about 2.5 billion of actual new money across every crypto fund there is. And of that, 1.92 billion went into the Bitcoin funds specifically. The pile did not grow. The price grew. And add up every dollar in and every dollar out of the American spot Bitcoin funds this year through Friday's close, and 2026 is still in the red. Even after the best week since last October's high, more money has left this year than has arrived. So the next time somebody tells you Wall Street is stampeding in, ask them one question. New money, or the same coins wearing a bigger price tag? It is almost always the second one. Now here is where it gets strange, and this is the part I did not know until this weekend. While all that money was sprinting in and out, the fund itself was selling Bitcoin every single day. Not because anyone asked it to, because it has to. Let me explain what you actually own in plain words. A Bitcoin fund is a jar of coins. Millions of people own slices of the jar. The slices are called shares. When a big Wall Street firm wants more slices, it hands over Bitcoin, and the fund cuts a new block of 40,000 shares. Wall Street calls that block a basket. So, how much Bitcoin sits behind one basket? BlackRock does not print that number for you. It publishes the pieces every day, the coins and the shares, and you do the division yourself. As of last Friday, a basket of 40,000 shares holds 22.65 Bitcoin. Now go back to the first quarter after the fund launched, March 31st, 2024. Take the coins in the jar and divide by the shares outstanding, straight off the filing. A basket held 22.7858 Bitcoin. 22.79 then. 22.65 now. The jar is bigger than it was. There are far more coins in it, but every slice of it is thinner. And here is the number that made me sit up. Run that decline out over the days between those two dates, and it comes to 0.25% a year. The fee on this fund is 0.25% a year. The same number to the second decimal arrived at two completely different ways. One off the fee schedule, one by counting coins. That is not a coincidence, and it is not an accident. That is the fee made physical. You are not paying it out of your checking account. You are paying it in coins. And let me get ahead of the sharpest person watching, because he is about to catch me. There was an introductory discount in the early days of this fund, and it sits inside the window I just measured, which means the real drag over that stretch is running a hair under 0.25%, not a hair over. The discount is dead now, so the number gets worse from here, not better. And BlackRock says so. Not in a footnote, in the prospectus, the document they are legally required to hand you. Their sentence. The number of Bitcoins represented by a share will decline each time the trust pays the sponsor's fee. And one more, from the same document, and read this one twice. Even if there are no expenses other than those assumed by the sponsor, and there are no other liabilities of the trust needs to sell Bitcoin to pay the sponsor's fee. The trust needs to sell Bitcoin. Their words, not mine. So how many coins has it needed? The filings count them for you, year by year, and the numbers reconcile against the total pile exactly, which is how I know they are real. 1,435 Bitcoin sold in 2024. 1,658 sold in 2025. Another 1,062 in the first 6 months of this year alone. Add them up. 4,155 Bitcoin sold out from under the people who own the jar in about 2.5 years. Now, BlackRock did not pocket what those coins are worth today. They took them at the prices of the day, a little every morning, averaging somewhere around 71,000 a coin. $294 million in fees booked since this thing opened. But those same coins, this morning, would be worth $324 million. That gap is not their problem. It is the problem of whoever owned a slice of that jar. And I need to draw a hard line here, because somebody is going to point out that the funds pile has dropped by a lot more than 4,000 coins this year, and he will be right. It has. Tens of thousands. But those two things are not the same, and the difference is everything. When investors leave, their coins leave with them. The jar shrinks, and so does the number of slices. Your slice is exactly the size it always was. Nothing happened to you. The fee is the other kind. It takes coins out and leaves every slice in place. Same number of shares, fewer coins behind each one. That is the only kind of loss you cannot see, cannot vote on, and cannot stop. If you want to watch these numbers the way I do, without reading tax filings on a Sunday, my macro command center at timtalksfinance.com/members keeps the live ones on one screen. Now somebody is thinking, fine, it is 0.25%. That is cheap. And compared to what your broker charged you in 1995, it is. But I want you to feel what 0.25% means on this particular asset. You bought Bitcoin because there will only ever be 21 million of them. That is the entire argument. The number cannot go up. Nobody can vote to make more. So when you own Bitcoin, the only score that matters is how many coins you have, not the dollar value, the count. $100,000 buys you about 1.282 Bitcoin today. 5 years from now, untouched, that share is backed by 1.266. You did not sell. You did not panic. You did not do one single thing wrong. About 16 thousandths of a Bitcoin just left anyway. Stretch it. 20 years, same $100,000, same quarter percent, nothing touched. You end up with about 95% of the Bitcoin you started with. One coin in 20, gone, for the service of being held. And here's the thing about that. It happens whether the price goes up or the price goes down. Bitcoin could triple or it could halve. Your coin count drops either way. The dollars can lie to you, the count cannot. Let me put it the way my grandfather would have understood it. Imagine you handed a man a bag of 100 silver dollars and asked him to keep it in his safe. Every 4 years, he takes one coin out of the bag. That is his fee. Nothing crooked about it. He told you up front. It is in the paperwork. You signed. Except he does not wait 4 years to do it. He shaves a sliver off a coin every single morning, and after 4 years, the slivers add up to one. But at the end, you do not have 100 silver dollars. You have 95. And the whole reason you wanted silver dollars was that nobody could make more of them. That is the deal. It is an honest deal. It is just not the deal most people think they took. And about that introductory discount, 12 hundredths of a percent instead of a quarter on the first $5 billion for the first 12 months. Both of those ran out. It ended on January 10th, 2025. The most recent quarterly filing says it plainly. Zero fees waived. Everybody pays full freight now. Now I have to stop and correct myself because I told you two things last month that were not quite right, and somebody in the comments would have found them anyway. First, I said BlackRock holds 800,000 Bitcoin. Here is the real shape of it. The pile went above 810,000 back in May, and that was the high water mark. By the time I told you 800,000 last month, it was already coming down. It is around 765,000 this morning. Still the largest pile of Bitcoin any company on Earth controls. Still about 3.6% of every coin that will ever exist. But 800,000 was stale, and I would rather correct it than let it sit. Second, and this one matters more, I told you all of it sits with one custodian, Coinbase. That is mostly right and not entirely right. Coinbase custody is the main one, yes. But the filing also names Anchorage Digital Bank as an additional Bitcoin custodian. The fund is permitted to hold coins at both, and the cash sits at a separate bank entirely. So it is not one door. It is two doors and a bank. I said one because one is a cleaner story. That is exactly the reason to say the true thing instead. If my numbers are not better than theirs, you have no reason to listen to me at all. Now, back to your money, because there is one more piece of this, and it is the piece that decides everything. You cannot turn it off. Not by holding tighter. Not by calling anybody. There is no button, no form, no phone number. Try the obvious move. Ring your broker tomorrow and say, I would like my Bitcoin, please. Send the actual coins to my actual wallet. The answer is no, and it is no in writing. The prospectus. Except when aggregated in baskets, shares are not redeemable securities. And baskets can only be handed back by what they call authorized participants. Registered broker-dealers, under contract, 40,000 shares at a time. 40,000 shares. At today's price, that is about $1.75 million. And even then, only if you are a broker-dealer with a signed agreement. So your only exit is to sell the shares. And when you sell, you get dollars. You do not get Bitcoin. You get a tax bill and a wire transfer. Think about what that means. You bought the asset whose entire selling point is that you can hold it yourself, that nobody stands between you and it. And the most popular way Americans buy it is a wrapper you cannot ever open. And it goes further than the fee. Remember the fork story from last month? When a group of people tried to change Bitcoin and could not? Well, if a fork ever does happen and it hands out free coins to every holder, what does your fund do with your share of them? Their language, and I could not make this up. The sponsor will cause the trust to permanently and irrevocably abandon them. Abandon. That is the word in the document. Any coins a fork drops in the fund's lap get walked away from, and they are not counted in what your share is worth. A man holding his own Bitcoin can go and claim those coins. You get a sentence in a prospectus. Then there is the insurance, which is the part I hear people lean on most. There is a $320 million crime policy at Coinbase. People hear that and relax. Read what the fund's own annual report says about it. That policy is shared among all of Coinbase's customers, and it is not specific to the trust. Shared among all of them. And the fund alone holds around $60 billion of Bitcoin. 320 million against 60 billion is about half of 1%, and that is before any other customer in the world gets in line ahead of you. And to be fair to them, that policy is not the only thing standing there. The coins sit in cold storage at a chartered trust company, held as customer property. But it is the only number they will give you, and half of 1% is what the number says. I am not predicting that anything goes wrong. It probably does not. Coinbase is large and regulated and careful. The point is not the prediction, the point is the shape. And once you have the shape, you start seeing it everywhere, because it is the shape of everything they are building right now. They are putting the whole world on digital rails. Your stocks, your bonds, the deed to your house, your savings, all of it, tokenized, moving in seconds. And every single one of those tokens has a man behind it. A tokenized bond has an issuer who decides how many exist. A tokenized house has a county registry that decides whose name goes on it. A stablecoin has a company that can freeze it on a Sunday afternoon. A digital dollar from the central bank has a printer, and a rule book, and now a list of things you are allowed to buy with it. And a Bitcoin fund has a sponsor who takes a slice of the coins every day, a custodian who holds the keys, and a document that says you may never ask for the coins. Every exit they have built you has a landlord standing in it. There is exactly one thing on that list with nobody behind it. 21 million Bitcoin. Fixed. Forever. Not by a promise, not by a policy anybody can change on a Sunday night, but by the way the thing is put together. No servers, only a protocol. Bitcoin you hold yourself does not have a sponsor. Nothing accrues against it daily. There is no basket, no waiver that expires, no 0.25% quietly walking out the back. If you hold one Bitcoin in your own wallet today, in 5 years, you hold one Bitcoin. In 20 years, you hold one Bitcoin. Nobody sells a sliver of it to pay themselves for the privilege of holding it for you. That is the entire difference. One of them shrinks, the other one does not. Now let me be even-handed, because I would rather you make a clear-eyed choice than a scared one. There are people for whom the fund is genuinely the right answer. If the only place you can hold Bitcoin is inside a retirement account, the fund is how you get any exposure at all, and that beats none. If you know in your bones that you would lose the little device or forget where you put the paper, then paying a professional to hold the keys is buying yourself protection from a bad afternoon. 0.25% is a fair price for that. Those people are not wrong. And I will say the harder thing too. Doing self-custody badly has cost an enormous number of people their coins. More than most of us in this corner of the internet like to admit. If anyone online ever asks you to type your recovery words into a website, that is a robbery in progress. Every time, no exceptions. So this is not me telling you to sell anything. That is your decision, and it is not mine to make. It is me telling you what you own in their own words. So you are choosing it on purpose instead of by accident. You own a share of a jar. The jar is real. The Bitcoin in it is real. And a little of it leaves every day to pay the man holding it. That is the trade. Know the trade, then take it if it suits you. There are no certainties here, only probabilities. The probability that the fee keeps taking 0.25% of your coins every year. That one is not a probability at all. It is arithmetic, and it is already in the filings. The probability that 21 million becomes 22 million, as close to zero as anything gets in this world. You can price the rest yourself. That is the point. I hand you the math and the door. Which side of it you stand on is up to you. If you would rather not read tax filings on a Sunday morning, I built something for that. Go to timtalksfinance.com/members and open a free account. No credit card, about 2 minutes. The live Bitcoin price sits right at the top, the same number I use, and the money quiz will show you in actual dollars what inflation is quietly costing the cash you are holding. I built it because I got tired of finding this stuff by accident. Nobody should have to dig through a quarterly filing to learn that their Bitcoin is being sold a sliver at a time. 4,155 coins. They never hit it. They filed it, on schedule, in public, where anybody could read it. They just knew that almost nobody would.